Welcome back, everyone. Today we are diving deep into one of the most powerful and honestly one of the most misunderstood tools in all of finance, the enterprise multiple. You've probably heard it called EV to EBITDA. So let's get right into it. Okay, so let's start with a classic valuation problem. Imagine you've got two companies. They look pretty similar on the surface, but their finances are structured in completely different ways. How in the world do you figure out which one is actually the better business at its core? And here's that problem in action. You've got Company A, which uses a ton of debt. That actually helps lower its tax bill. Then you have Company B, funded completely by equity, and it gets hit with a higher tax rate. Now, if you just looked at their bottom line net income, you'd get a totally skewed picture. So the real question is, how do we look past all this financial engineering? This right here is exactly the puzzle that the EV to EBITDA multiple was designed to solve. It is the professional's go-to tool for cutting through all that noise from financing and tax just to get to the heart of a business's operational value. All right, so to really master this, we have to deconstruct it. We're going to break it down piece by piece, starting with the two main components of the ratio itself. That's enterprise value and EBITDA. Let's start with enterprise value, or EV. Now forget the complicated formulas for just a second. I want you to think of EV as the actual price you'd pay to buy the whole company, lock, stock, and barrel. You'd start with its market cap, right? The value of all its shares, but you also have to take on all its debt. That's your responsibility now. And then finally, you get to subtract any extra cash sitting around that the business doesn't need to run, because hey, that cash is yours now. And this is the magic of enterprise value. Because it includes both debt and equity, it becomes capital structure neutral. It just doesn't care if a company is funded with a mountain of debt or entirely by its shareholders. It just looks at the total value of the operating business. It's a beautiful thing. Okay, now for the other half of our ratio, EBITDA. I know, it's a mouthful. It stands for earnings before interest, taxes, depreciation, and amortization. But the idea behind it is actually pretty simple. It's trying to give us a clean, unvarnished look at how profitable the company's main operations are before we account for things like financing choices, different tax rates, or non-cash accounting quirks like depreciation. So, we've built the ratio, we understand the pieces. Now let's talk about what the final number actually signals about a company. What is it telling us? This is really where the art of analysis kicks in. So if you see a high multiple, let's say 15 times EBITDA, that's a big signal. It means the market is super optimistic and it's pricing in a lot of future growth. You're paying a premium for that. On the flip side, a low multiple, maybe something like 6x, could mean the company is a hidden gem, a potential bargain. Or it could be a massive red flag that the market sees big risks ahead. You have to remember, context is everything here. And make no mistake, this isn't just some textbook theory. Out in the real world, this multiple is a workhorse. It's used every single day. Equity analysts use it to compare companies in the same industry. Investment bankers use it to hammer out prices for M&A deals. And it's even a crucial part of building those big, complex valuation models, like a discounted cash flow analysis. Okay, now we're getting into the pro-level stuff. A top-tier analyst will never, and I mean never, just pull the numbers straight from a financial statement and plug them into a formula. The real art, the real value, is in making adjustments. See, the whole point is to find what's called a normalized or an adjusted EBITDA. And that means you have to dig into the company's financial reports and strip out all the one-time weirdness. Things like a huge restructuring charge or the cost of shutting down a factory. You want to get to a number that shows the company's true, sustainable earning power. And there is no better example of why this is so critical than a massive accounting change that happened recently called IFRS 16. It has to do with how companies account for their leases, and let me tell you, it created a huge artificial distortion in reported profits. So, let's break this down because it's so important. Before this rule, the money a company paid for rent, say for its stores or its airplanes, was a simple operating expense. It reduced EBITDA. Simple enough. But now, that very same cash payment is split into two parts, depreciation and interest. And guess what? Both of those are excluded from EBITDA. The result? The company's EBITDA looks way higher, even though not a single extra dollar of cash came in the door. So a professional analyst has to go in and manually reverse this whole thing just to get back to a true apples-to-apples comparison. But here's the warning that comes with this power to adjust. Companies can get really, really aggressive with their own adjustments to make their business look a lot more profitable and a lot less risky than it truly is. In fact, think about this. Arguments over what should or shouldn't be in the adjusted EBITDA number are at the center of nearly 40% of all M&A disputes. It's a big deal. And that leads us to probably the most important part of this whole discussion, understanding what EBITDA doesn't tell you, because it has some absolutely massive blind spots. Okay, if you only remember one thing from our time together today, please make it this. EBITDA is not a proxy for cash flow. It's just not. You hear people say it all the time, but believing that myth can lead you to some truly disastrous investment decisions.
To really see why, let's just look at a number: $15 billion. For a huge industrial company, this could easily be its annual spending on what's called capital expenditures, or CapEx.
And here is the fundamental problem. EBITDA completely ignores that $15 billion. That's real, hard cash that the company has to spend every single year on things like new factories and new equipment, just to stay competitive and hopefully grow. For any capital-intensive business, ignoring CapEx just massively overstates how healthy the company really is. And it's not just CapEx. EBITDA also totally ignores changes in working capital. Just think about a company that's growing really fast. It needs cash to build up its inventory, right? And it needs cash to float its sales to customers who haven't paid their bills yet. All of that consumes cash, it's a real drain on the business, and EBITDA is completely blind to it.
So, after all that, how do we use this incredibly powerful tool without falling for its traps? Well, the answer is to have an integrated strategy, to treat EV to EBITDA as just one piece of a much larger puzzle.
So here's your professional's checklist. Number 1, always normalize your numbers. Adjust for all that one-time stuff. Number 2, never use EBITDA in a vacuum. You have to cross-validate it with real cash flow metrics. And number 3, know the industry you're looking at. For a business that needs a lot of heavy machinery or factories, a metric like EV to EBIT, which actually includes depreciation, is often a much safer bet.
And that really brings us to our final core takeaway. The EV to EBITDA multiple is brilliant. It's brilliant at telling you the price of a business compared to its peers. But what it does not tell you is the true, ongoing economic cost that's required to maintain and grow that business's earnings. So, the next time you're reading a report and you see a company valued at, say, 10 times EBITDA, I hope this will encourage you to stop and ask that critical follow-up question. What is this multiple hiding from me? What are the real costs this number just isn't showing me? Thanks for joining me.